Recession is coming. Is it a necessary evil? Recession, the word, comes with pain, fear, and uncertainty. Our economy has gone through a lot in the last 2 years, from the destructive pandemic to the war trade and now witnessing the real wars. Everything has somehow added as a sudden bout of pessimism hammers financial markets, which has caused some serious effects in the economy. The waves of recession. The US economy could be heading for a recession in the next year, according to growing warnings from banks and economists. But can recession be healthy and necessary for one's economy? Don't worry, we haven't gone mad. The fact that recession can be good and necessary for economies is what the big and intellectual economists have to say. But why? Let's find that out in this video. Hey everyone, welcome back to Country Economies Explained. Make sure to like and subscribe to the channel. Having said that, let's begin. Public opinion is generally quite simple in regard to recession. Upswings are generally welcomed, recessions are to be avoided. But do you actually know what a recession actually implies? Unemployment rising, company profits falling, financial markets tumbling, and the housing sector collapsing. General word to describe these developments? Recession. But is it even fair and true? To know that, we have to first understand what a recession actually means. You'll be surprised to know that there is no official definition of recession, but there is general recognition that the term refers to a period of decline in economic activity. Very short periods of decline are not considered recessions. Most commentators and analysts use as a practical definition of recession 2 consecutive quarters of decline in a country's real inflation-adjusted gross domestic product, GDP. The value of all goods and services a country produces. Although this definition is a useful rule of thumb, it has drawbacks. A focus on GDP alone is narrow, and it is often better to consider a wider set of measures of economic activity to determine whether a country is indeed suffering a recession. Using other indicators can also provide a timelier gauge of the state of the economy. One of such is in the United States, the Private National Bureau of Economic Research, NBER, which maintains a chronology of the beginning and ending dates of US recessions. The NBER's Business Cycle Dating Committee defines a recession as a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in production, employment, real income, and other indicators. A recession begins when the economy reaches a peak of activity and ends when the economy reaches its trough. Anyhow, this pattern of recession is consistent with the historical record. Simultaneous or synchronized recessions have occurred in advanced economies several times, like the US in the past 4 decades. The mid-1970s, early 1980s, early 1990s, and early 2000s. Because the United States is the world's largest economy and has strong trade and financial linkages with many other economies, most of these globally synchronized recession episodes also coincide with US recessions. So are they about to have another coincidence? Despite all the talk, the US entering another recession, the unemployment rate of 3.6% remains historically low, job growth remains strong, and notwithstanding inflation, consumer spending continues to be like a fire hose. That said, the US economy shrank by an annualized rate of 1.4% in the first quarter of 2022, which means we may already be well on our way to the technical definition of a recession, albeit maybe a teeny tiny one. Yes, you got that right. It's being whispered and murmured about. The president is facing questions about it. The business leaders and investors are already bracing for it. The specter of recession is once again rearing its monstrous head. But do we really need to worry about it? It's feasible that the economy could chug along without any bumps or crashes, but boom and bust cycles remain a seemingly inescapable feature of capitalist economies. Some countries have done well avoiding busts. Starting in 1991, Australia had a run of almost 29 years without a recession, the longest stretch of economic growth of any nation in modern history. That ended in 2020, when the pandemic led to a big contraction, and Australia briefly succumbed to the beast. While Australia had 0 recessions between 1991 and 2020, the United States had 2. A mild one in 2001 amid the dot-com crash and the 9/11 terrorist attacks, and a catastrophe one known as the Great Recession between 2007 and 2009. Since 1854, the first year for which we have official economic data, the United States has experienced 35 recessions. It kind of makes a pattern in history, right? But what is the cause behind this pattern? What makes a country move toward a recession? Understanding the sources of recessions has been one of the enduring areas of research in economics. There are a variety of reasons recessions take place. Some are associated with sharp changes in the prices of inputs used in producing goods and services. A recession can also be triggered by a country's decision to reduce inflation by employing contractionary monetary or fiscal policies. Other recessions, such as the one that began in 2007, are rooted in financial market problems. And you will be surprised to know that not all recessions are bad. Some of them are necessary evil and are inevitable, like the boom and bust recession. Many recessions occur after a previous economic boom. How? Follow the lead. In the economic boom, economic growth is well above the long-run trend rate of growth. This rapid growth causes inflation and a current account deficit, and the growth tends to be unsustainable. When the government, central bank, see that inflation is getting out of control, they respond by implementing tight monetary policy, higher interest rates and tight fiscal policy, higher taxes and lower government spending. As a result, there tends to be a fall in the savings ratio and a rise in private borrowing to finance higher spending. The economic boom is financed by rising debt. Therefore, when there is a change in economic fortunes, consumers radically change their behavior. Rather than borrowing, they seek to pay off their debt, and the saving ratio increases, causing a fall in spending. These types of recession can often be short-lived, if caused by high interest rates. Reversing rate increases can cause the economy to recover. And that's why it is said that this type of recession can accelerate the process of creative destruction and can be evil but necessary for the economy, as it forces firms to increase efficiency or go out of business. But the thing to remember is that a recession resulting from an economic imbalance may rectify it, clearing the way for a return to growth. For example, the 1981 to 1982 recession, which was triggered by Federal Reserve interest rate increases in response to high inflation, helped to lower the inflation rate from 11% in June 1979 to 5% by October 1982. And the US economy grew for the next 8 years. But it doesn't change the fact that recessions are a natural, unavoidable stage of the economic cycle that invariably bring hardship to individuals who lose their jobs or businesses. So, do you need to worry about the upcoming recession? Although major swaths of the economy, including the job market and consumer spending, remain robust, there are mounting worries that rising borrowing costs for consumers and businesses after years of near-zero interest rates could cause a sudden retrenchment. The Federal Reserve has raised interest rates by 0.75 percentage points so far this year, while officials are signaling more aggressive increases could be necessary to cool the economy. Continued uncertainty from the coronavirus pandemic and Russia's invasion of Ukraine are adding to the uneasiness. But recently, President Biden wrote a Wall Street Journal op-ed this week, spelling out his plan to bring down the highest inflation the United States has seen in 4 decades. Biden said his plans has 3 parts: supporting the Federal Reserve in its effort to control inflation, fighting rising fuel costs worsened by Russia's Ukraine invasion, and fixing disrupted supply chains, and reducing the federal deficit by winding down any emergency programs that are no longer necessary and reforming the tax code. Biden said the US is in better economic shape than most of its allies, with families saving up and manufacturing jobs growing at their fastest pace in 30 years. With the right policies, Biden wrote, the US can transition from recovery to stable, steady growth and bring down inflation without giving up all these historic gains. We hope you got your answer. This was it for today. What do you think? Is a recession inevitable and necessary evil, or is there a less painful path to recovery? Share your views in the comment section below, and don't forget to like, share and subscribe to the channel for more of such amazing and informative videos. This was all for today. We'll see you in the next one. Until then, peace.